This lesson is about accounting for partnership business. It is the first lesson about partnership business and therefore has a lot of introductory issues. It has a lot of concepts which are introducing the partnership business and the concept of accounting for partnership business. The issues addressed in this lesson include the following. After the lesson, the student should be able to describe the formation of a partnership form of business. The student should be able to identify the characteristics of a partnership form of organization and explain the various contents of partnership agreement, which will be explained in this particular lesson. To start with, I would like to explain various terminologies or concepts that will be used in accounting for partnership business. The first one is partnership, and a partnership is an association of two or more persons who form a partnership business and carry on a business as co-owners for purposes of making and sharing profits. The main thing is therefore that they generate and share the profits of such a partnership business. Also, a partnership can be a legal entity for certain purpose. For example, a partnership can be formed to own an asset together, or it can be an accounting entity for purposes of reporting only. In this case, the business may not necessarily be done together, but the reporting is done together as a partnership. The net incomes of a partnership are not taxed on the partnership separately. Instead, each partner gets their share of the income of the partnership, and then it is taxed on them on based on personal tax rates, which is applicable in each and every country. The next term is Partnership Act. A Partnership Act, these are the basic rules which guide the formation and operation of a partnership. Usually, these partnership acts, because they're being made in each and every country, they have close similarities because partnership form of business tend to be similar across countries, but then not exactly the same in each and every country. Partnership Act, therefore, guides the following: formation of partnership business, types of partnership business, membership of partnership business, and any other important operating procedures. Next, let us look at the characteristics of a partnership business. A partnership form of business organization has the following features. Association of individuals, which we have looked at from the definition, co-ownership, limited life, unlimited liability, and mutual agency. These features of a partnership business are elaborated in the following slides. To begin with, mutual agency. Mutual agency here is to mean that each partner acts on behalf of the other partners when engaging in a partnership business. Any activity conducted by one partner on behalf of the partnership is binding on the other partners. That partner acts as an agent of the other partners. So act of any partner is binding to all the other partners, and that is what mutual agency means. It has both risks and it has also advantages. Even when a partner acts beyond the scope of their authority, as long as the act appears to be appropriate for the partnership, then it is considered to be binding to all the other partners. That is what mutual agency means. Next is that a partnership is association of individuals. Association of individuals here is that a partnership cannot be a partnership when it is one individual or when it is one person. Therefore, a partnership may be based on simple acts as a handshake, but it is preferably to state it is preferable to write the agreement, partnership agreement, that is guiding the operation of a partnership business. Next is limited life. Meaning of limited life is that a partnership may be dissolved whenever each partner withdraws or a new partner is admitted. What does that mean? A partnership may be ended voluntarily, involuntarily by death or incapacitation of one partner, or it may be ended voluntarily through acceptance of a new partner or withdrawal of an existing partner. So these are very important events that when they take place in a partnership business, then a partnership is considered to have been reformed afresh, or the partnership life is ended and a new partnership has been formed. Unlimited liability. This means that each partner is personally and individually liable for all the partnership liabilities. To mean they are liable to creditors, claims, they are liable to make good the insufficiency of the assets of the partnership towards the claims of the creditors. So first, creditors attach the assets of the partnership. But if the assets of the partnership are insufficient, then the claims attach to the personal resources of any partner, irrespective of that partner's capital equity in the partnership. There is co-ownership. Co-ownership here is that a partnership assets are owned jointly by all the partners. Partnership income or loss is also co-owned. So if the partnership agreement does not specify to the contrary, then net incomes of the partnership are shared equally by the partners. But usually you find that partners have an agreement which states the basis of sharing profit or the ratio on which profit is shared, which is the profit sharing ratio among the partners. Advantages and disadvantages of a partnership form of organization. First is the advantages. In a partnership, partners are combining skills and resources from more than one individual, that is from two or more individuals. And in this case, you find that there will be kind of unique skills, there will be kind of comprehensive skills put together, as well as resources. In terms of resources here, is about the power of the resources that can be contributed by more people than one individual. There is ease of formation. This can be compared to formation of a limited liability company. Formation of a partnership is more easier than a limited liability company based on the procedures and the requirements. Freedom from governmental regulations and restrictions. In partnership, individuals are expected, or the partners are allowed to make their own agreement. That is not so possible in a company because company is closely regulated by the government regulations. Ease of decision making. In partnership, sometimes an individual can make decisions for the others. In a company, that is not possible because there must be a resolution by a majority. Disadvantages or limitations. There is mutual agency, that is any decision made by one partner, all the partners is liable for. So if it is a mistake, that mistake affects everyone. Limited life. A partnership can easily be dissolved by just death of one partner or admitting a new partner. Unlimited liability. Partners are responsible for the liabilities of the partnership in such a situation that if the partnership cannot settle all its creditors, then the partners will be called upon to settle such creditors from their own assets, individual assets. The next concept is about partnership agreement. Partnership agreement. A partnership agreement is a contract between the partners. It contains the terms of agreement which the partners will base their operations on. A partnership agreement, therefore, may be oral or can be written. And for it to be effectively applied, it should be written. This is in a situation where it is written, partners will sign it and it binds them. And this can easily be referred to in case of a dispute among the partners. In that case, they refer to the agreement they made, which even the courts of law can refer to. If the partnership agreement is written, then the partnership agreement as written, the document is known as partnership deed. A partnership deed is a written document which shows the terms and conditions upon which a partnership business is operated. Therefore, a written partnership agreement document is called partnership deed. Contents of a partnership agreement include the following: the names and addresses of the firm and the partners. So all the partners in a partnership business, their names must be indicated, and also their addresses. The nature and places of business. The nature of the business must be described in the partnership agreement, and the places of business, the various premises where such business is taking place. Date of commencement of the partnership must also be stated. Amount of capital contributed by each partner. This can be capital contributed at the beginning or any additional capital to be contributed by the partners. So the capital that the partners will start with and the capital that the partners will be required to contribute going forward must be stated in the partnership agreement. Profit sharing ratio is very important because the partners come together with objective of making profits, and therefore they must state how such profits, when made, will be shared among them. And that also applies to the losses if suffered. Interest on partners' capitals and drawings. Very important that sometimes partners may want to draw some money from the business. Drawings are like borrowing from the business, which are supposed to be returned. In this case, partners will be charged some interest by the business, and that need to be stated much earlier before starting the partnership business. That applies also to capital of partners, where some partners may contribute more capital than others, and therefore a capital interest on capital is attached to the capitals to benefit those partners who have contributed more capital to the business. Salaries, commission, bonus, or any other remuneration or benefits that partners may get from the business must also be stated. Any benefits or any remuneration payable to any partner in the partnership. Procedures for admission or withdrawal of a partner. Partners must agree on how to admit anyone who wants to join the partnership business. And also, in case of a partner want to withdraw from the partnership business, such procedures must be followed and must be clear to all the partners so that there is no kind of dispute when such a situation occurs. Now, with that short lesson, what is coming next, or what is following this lesson, is that we will be looking at the methods of maintaining partners' capital account in a partnership business, which includes the fixed capital method. And in the fixed capital method, we prepare the partner's capital account and the partner's current account. That will be followed with fluctuating capital method, which is the other method of maintaining partner's capital account. And in that situation, we shall prepare partner's capital account. Now, in the next lesson, we are also looking at financial statements, preparation of financial statements. That is a statement of profit or loss together with appropriation of profits and statement of financial position. So look at the next lesson, which is explaining this in details so that you get more in terms of accounting for partnership form of business.